Everyone thinks the 2018 Christmas crash was just a glitch, a hiccup in the markets caused by a jittery Fed and some bad tweets. But the truth is, it was the shadow of something far deeper, a system stretched so tight by artificial money, debt, and political bluffing that even a minor tremor nearly snapped it. Between December 3rd and December 24th, 2018, the S&P 500 dropped over 15%. That's not a correction, that's a panic. On Wall Street, they call it the worst December since the Great Depression. And it happened while most people were distracted with shopping bags and holiday dinners. The headlines said it was about interest rates, about the Fed raising its benchmark a measly 0.25%, or about Trump clashing with his own central bank, or fears of a trade war with China. All of that made noise, but none of it explains the pattern, because it wasn't just 2018. There's a strange rhythm here, and if you look closely, it keeps beating through financial history. Crashes that start quietly in December then echo louder months later. 2000, 2007, 2018. Each time, a bigger asset bubble had been built on cheap money. Each time, the central banks tried to take the punch bowl away. And each time, the system flinched. It's not just a coincidence. It's not just the holidays. There's something about the end of the year, a hidden mechanism, that forces the truth to briefly appear. Think about it. Every year, global markets have to settle accounts. Hedge funds, pension funds, sovereign wealth portfolios. They close books, crystallize gains, rebalance risks. When liquidity thins, illusions vanish. And the deeper the illusion, the harder the snap. In 2018, the illusion was that 10 years of zero interest rates hadn't changed the DNA of the financial system, that we could go back to normal. But the moment the Fed nudged rates above 2%, markets screamed. Why? Because the game had shifted. Cheap debt had become a requirement, not a stimulus. Like an addict who needs the next fix just to feel normal. And now that same pattern is setting up again. 2026 is not just another year. It's the end of a cycle, a point where debt maturities, inflation denial, and political promises collide again. If you want to understand why the next big shock won't be random, why it's scheduled in the design of the system, we have to go deeper. It's not just about crashes, it's about timing, and what the system is forced to reveal when the lights are dimmest and the books are due. To understand why December crashes happen and why 2026 may be the next, we have to go back. Not just to 2018, not just to 2008, but to the years when money stopped being a mirror of value and started becoming a lever of control. This shift didn't begin with Wall Street. It began with trust. More precisely, with the need to manufacture trust when the real foundations were gone. After the collapse of Bretton Woods in 1971, when the U.S. officially detached the dollar from gold, the global financial system became something new. A floating web of promises, debts, and digital balances, all backed by nothing but confidence in the central banks that issued them. From that moment, every major economic model, every pension fund, insurance portfolio, national budget became tied to one thing: interest rates. Because in a fiat world, where money is no longer anchored to gold or land or labor, the cost of borrowing is the anchor. And central banks became the high priests of this new religion. In the 1980s, Paul Volcker had to crush inflation by raising U.S. rates above 19%. That nearly destroyed the economy, but it showed one thing: the Fed could still impose discipline, if it had the will. After him came Alan Greenspan, who preached markets but quietly practiced intervention. Whenever markets dipped, he cut. Whenever they rallied, he waited. This became known as the Greenspan put, an unwritten promise that the Fed would always step in before things got too ugly. By the 1990s, the world had absorbed the lesson. Markets weren't just guided by fundamentals, they were backstopped by policy. And then, slowly, quietly, the line between economy and central bank began to blur. After 2000, the dot-com crash, the Fed slashed rates again. In 2008, it didn't just cut rates, it flooded the system with trillions of dollars through quantitative easing, bond buying, and secret credit lines to foreign banks. What used to be emergency tools became standard tools. Monetary adrenaline became part of the daily bloodstream. And this is where the real system was born. It's not just about central banks printing money. It's about what that money does once it's in the bloodstream. Cheap credit created leverage. Companies borrowed not to invest in factories or workers, but to buy back their own shares. Hedge funds borrowed to bet on everything from Argentine debt to Bitcoin. Governments ran massive deficits without fear because interest payments stayed near zero. Everyone became more fragile, but also more addicted. And underneath it all sat a mechanism few people noticed: year-end liquidity pressure. Every December, banks, funds, and corporations have to reconcile their books. This means settling trades, meeting regulatory capital requirements, balancing derivatives, rolling over short-term debt. If funding is tight or risk is rising, even a small squeeze in liquidity can cause big tremors. In a healthy system, this isn't a problem. In a leveraged system built on rolling short-term debt, it's a match near a dry forest. That's what almost happened in December of 2018. That month, the Fed's balance sheet was still shrinking, part of its plan to normalize. Rates had climbed to just above 2%. And in those 21 days leading up to Christmas Eve, the markets cracked. Behind the scenes, corporate debt was peaking at over $9 trillion. Junk bond spreads widened. The overnight repo market, where banks lend to each other to keep the system liquid, began flashing red. That December, there were days when no high-yield bonds were issued at all. Zero. The first time since the 2008 crisis. And yet, on the surface, the economy looked fine. Unemployment was low, GDP was growing, corporate earnings were strong. But the numbers didn't lie. The financial plumbing was dry, and markets knew it. By December 24th, the fear was so bad that Treasury Secretary Steven Mnuchin called the CEOs of the 6 largest banks to assure the public they were still solvent. That kind of call only happens when people are whispering about collapse. Then, like clockwork, the Fed blinked. On January 4th, 2019, Jerome Powell made a sudden pivot, saying the Fed would be patient and flexible with rate hikes. Just like that, the market surged. The illusion was back. But if you understand systems, you know what really happened. The pressure had revealed the weak points. The Fed had no room to tighten. The debt load was too big. The structure was too fragile. Any serious attempt to normalize interest rates would tear the whole thing down. And now, the same system is even bigger. Global debt has crossed $300 trillion. Interest rates briefly went up again in 2022-2023, but many governments, corporations, and households are still rolling over debt every few months, just hoping the music doesn't stop. But it always does, in December. Because that's when books close. That's when games of extend and pretend hit a wall. And that's why 2026, with a wall of bond maturities, a squeezed U.S. Treasury, and political paralysis, might not be a crash out of nowhere. It might be the system's own design finally catching up. Systems don't collapse because of bad intentions. They collapse when numbers outgrow gold, real income, or trust. If you had looked at the world in early 2019, right after that Christmas panic, you'd have thought the system was cured. Markets bounced. The S&P 500 surged nearly 30% that year. Tech stocks exploded. The Fed had paused its rate hikes, liquidity was flowing again, and behind all of it, one illusion ruled. We can do this forever. This is the most dangerous moment in any empire, any system, any speculative boom. The moment when people stop thinking they're playing a game and start believing the game is reality. Because the deeper truth is this: the rebound after the crash is the most seductive phase of all. It's when the heroin hits just as the withdrawal was about to begin. And 2019 was a masterclass in illusion. Corporate profits were fine, but corporate debt was record high. Central banks were pretending to be neutral, but quietly pumping more liquidity back into markets. Retail investors were pouring money into index funds, chasing 10% annual returns like it was gravity. And the media? It played its usual role, calling this the Goldilocks era. Not too hot, not too cold. But underneath the surface, the math never worked. The only reason companies could afford their debt was because interest rates were artificially low. The only reason governments weren't defaulting was because central banks were indirectly buying their bonds. And the only reason stocks kept rising was because companies were using debt to buy back their own shares, reducing supply while juicing demand. This wasn't value creation, it was balance sheet engineering. Take Apple. In the 5 years leading up to 2020, it spent over $300 billion on buybacks and dividends. That's not investment in new factories, new workers, or new breakthroughs. That's extraction, pulling future value forward to boost today's price. And the public? We were hypnotized. We told ourselves this was normal, that the Fed could keep rates low forever, that inflation was gone, that debt didn't matter. We built a religion around the central bank and made the high priests untouchable. Remember, from 2009 to 2019, the Fed's balance sheet swelled from under $1 trillion to over $4.5 trillion. The ECB, Bank of Japan, and Bank of England followed suit. Global central banks collectively printed over $20 trillion during that period. And instead of creating growth, it created dependency. Everything became tied to the next injection of liquidity. In the 18th century, France did this with paper assignats. Backed by confiscated church land, they were supposed to be temporary. But once the printing started, stopping meant collapse. So they kept printing until the currency died and trust with it. In our modern version, we didn't print notes. We printed digital claims on future value. Bonds, credit, derivatives, synthetic money with no anchor. But the logic was identical. And like in all great illusions, there were prophets, warning but ignored. In 2019, a few economists started whispering about distortions, about asset bubbles, about zombie companies, firms that could only survive because debt was cheap. The Bank for International Settlements warned of debt traps and policy impotence. But markets didn't care. Why would they? Everything was rising. And then, as always, nature stepped in with a shock no one predicted. March 2020, the pandemic, global lockdowns, and suddenly the illusion snapped. But here's what most people miss. The real collapse in 2020 wasn't just from the virus. It was from the fragility built over the decade of artificial calm. The system cracked not because of a health crisis, but because it had no buffer left. Within days, credit markets froze. Treasury bond markets, supposedly the safest on earth, stopped functioning. The Fed had to step in with unlimited liquidity, slashing rates back to zero, buying corporate bonds, bailing out money market funds, and pumping $120 billion per month into the system. It was 2008 on steroids. And again, the illusion returned. By the end of 2020, markets were at all-time highs. Crypto was booming. Retail investors on apps were trading stocks like poker chips. The Fed's balance sheet crossed $7 trillion. In debt, nobody cared. Nobody wanted to care. This is the rhythm of monetary illusion. Crisis, rescue, euphoria, dependency, fragility, crisis. And in 2018, the tremor showed us the cracks. In 2020, the facade collapsed. But instead of reforming the system, we doubled down on the illusion. By 2021, inflation was waking up, but rates were still at zero. Real estate, stocks, crypto, luxury goods, all pumped by stimulus and speculation. By 2022, inflation hit 9% in the US, and suddenly the old illusion died again. Because when the cost of money rises, the ghost of every bad loan, every over-leveraged bet, every artificial growth plan returns to collect. And the same pressures that made December 2018 a warning are building again. We didn't fix the engine, we just painted over the warning lights. Arithmetic cannot be deceived, and illusions, no matter how well financed, eventually meet the real world. If you're seeing the cracks already, tell us what you're noticing where you live. Every bubble pops differently, but the pressure feels the same. There's a moment in every illusion where the trick fails, not because the magician made a mistake, but because the audience finally blinked. That moment came in 2022. After a decade of printing and pretending, the bill arrived. Inflation, that ancient force everyone said was dead, came roaring back. Not 2%, not 3%, 9% in the US, double digits in the UK, over 20% in parts of Eastern Europe. The era of cheap everything collapsed almost overnight. And suddenly, the very foundation of the post-2008 system began to crack. Because everything, and we mean everything, had been priced on the idea that money would stay cheap forever. Mortgages, corporate bonds, tech valuations, government deficits, startup funding, pension liabilities, all of it had been calculated on near zero interest rates. It was a financial architecture built not on stone, but on whipped cream. And once the Fed was forced to raise rates, fast, the math turned hostile. Let's make this painfully clear. If a government borrows at 1%, it can pretend debt doesn't matter. It can roll it over indefinitely. But if that rate jumps to 4% and you're sitting on a $30 trillion national debt, suddenly your interest bill quadruples. That's what happened to the US. Its interest payments, once manageable, began approaching $1 trillion per year. Now apply that logic to corporations, to households, to developing countries borrowing in dollars. The moment the price of money rises, everything starts to break at once. It's no longer a matter of opinion, it's arithmetic. And so, throughout 2022 and 2023, the dominoes began to fall. Crypto firms imploded. Over 5,000 tech workers were being laid off per week. Silicon Valley Bank, once a darling of the startup world, collapsed in March 2023 after a classic run triggered by bond losses and panic. Credit Suisse, one of the oldest banks in Europe, fell into crisis and had to be forcibly merged with UBS. The fragile balance of the post-2018 illusion, cheap debt, high valuations, endless Fed support, was exposed as a house of glass. And still, we pretended. Central banks hiked rates to fight inflation, but governments kept spending. The US passed trillion-dollar stimulus bills. Europe poured money into energy subsidies. Japan kept printing, even as the yen collapsed. It was like trying to fix a fire with gasoline, because stopping would mean admitting the truth. And here's the truth. The system we built since 2008 cannot survive normal interest rates. It's not designed for stability. It's designed for inflation to remain hidden, for debt to be cheap, and for assets to rise, always. The moment one of those pillars fails, the spell breaks. In December 2023, almost exactly 5 years after the 2018 flash crash, the cracks widened again. The U.S. Treasury held one of its worst bond auctions in decades. Foreign buyers pulled back, yields spiked, and behind the scenes, the financial world whispered the same fear they had whispered in 2018. What if the system can't hold? Liquidity dried up. Commercial real estate began defaulting in major cities. Even mighty U.S. regional banks saw their stock prices cut in half. The everything bubble, stocks, bonds, property, tech, even government debt, began to deflate. But it didn't collapse all at once. That's not how systems fail. They fail in phases: denial, panic, rescue, and finally, exhaustion. And the most dangerous phase is the one we're entering now: calm before the reckoning. This is exactly where we were in late 2018, a temporary bounce, a forced calm, a lull created by central bank messaging. But the underlying math hasn't changed. The debts are bigger, the buffers are thinner, and the pressure is returning, right on schedule. By 2026, we'll be at another inflection point. Massive piles of U.S. debt will mature that year, over $8 trillion in Treasury securities. Corporations will face refinancing cliffs. Europe will still be struggling with energy shocks and demographic collapse. And the U.S. will be in the middle of a deeply divided presidential cycle. It's not just a market story anymore. It's a political and social pressure cooker waiting for a trigger. And here's where history whispers again. In 1796, the French paper money system collapsed not in a bang, but in a sequence of failed confidence tricks. Assignats gave way to mandates. Mandates gave way to forced lending. Each new fix only revealed how broken the last one was. By the end, people weren't just poor, they were angry. They stopped believing in the game entirely. The same dynamic is unfolding now. You can feel it in the rise of populism, in the distrust of institutions, in the financial anxiety spreading through every class. The illusion held for longer than most thought possible, but 2018 gave us the warning. 2020 gave us the cover story. 2022 broke the model. And 2026, that may be the year the math wins. Because at a certain point, you can't print over trust. You can't borrow past gravity. And you can't pause the clock when the system needs to settle accounts. If you're watching this and you still believe the experts are in control, ask yourself one thing. Why are they so afraid of December? Look around you now. December is approaching again. The charts are rising, but the foundations are cracking. And once you've seen the pattern, you can't unsee it. 2018 wasn't an anomaly. It was a preview. 2020 didn't fix anything. It buried the damage under trillions of digital dollars. And 2022 wasn't a surprise. It was the system doing what it always does, breaking under the weight of its own arithmetic. Now comes the echo. Today, in late 2025, the same old structure is back, but older, more fragile, and more desperate to look strong. The U.S. federal debt is past $34 trillion. Interest costs are consuming more of the budget than defense. Nearly half of all U.S. debt matures in the next 3 years. That means it has to be refinanced at higher rates in a market with fewer willing buyers. Foreign central banks are backing away. China is reducing its exposure. Japan is trapped in its own bond-buying spiral. The Fed is trying to pretend it can still fight inflation while quietly laying the groundwork for rate cuts again. It's 2018 déjà vu, but this time the cushions are gone. Meanwhile, corporate America is sitting on record levels of junk-rated debt. Many firms that borrowed at 2 to 3% in 2020-21 now face refinancing at 6 to 8%. Those aren't adjustments. They're death sentences for companies that never made a profit without cheap debt. And consumers? They've gone from stimulus checks to record credit card balances, now crossing $1.3 trillion with interest rates above 20%. Student loan payments are back. Mortgage rates are unaffordable. And yet, we're told the economy is resilient. But that's not resilience. That's momentum. And momentum, when it hits resistance, becomes collapse. The pressure is returning right on schedule. Already, liquidity is drying up again. In late 2025, repo markets are jittery. The Treasury is running emergency cash management games. Behind closed doors, officials are whispering about financial plumbing and market functioning, the same terms they used in 2018, 2020, and before the GFC. And if you want to know what happens next, look at the behavior of central banks. They've stopped pretending they'll ever shrink their balance sheets. The ECB, Bank of Japan, and now even the Bank of England are admitting that neutral rates might be a thing of the past. In plain English, they can't raise rates without breaking the system, and they know it. That's why 2026 is shaping up not just as another December scare, but as a mathematical wall. A wall of refinancing, a wall of maturing debt, a wall of political paralysis, a wall of collapsing trust. Because once again, the end of the year will force the system to settle up. And this time, the numbers are too big to hide with another press conference. Think of it like this. Every December is an X-ray. It doesn't create the illness, it reveals it. And in 2026, that X-ray will show a system too complex to save and too expensive to service. That's when the real reckoning begins. Not just financial, but political, social, psychological. Because when faith in money cracks, every other structure built on top of it begins to sway. History shows this clearly. The British Empire collapsed not when it lost a war, but when it lost the pound's credibility as a reserve currency. France descended into chaos in the 1790s, not because people suddenly turned on each other, but because trust in paper assignats collapsed. Argentina, Zimbabwe, Weimar Germany. The pattern is identical. The loss of trust always precedes the loss of order. And what are we seeing now? Central banks are buying gold again, quietly, but in record quantities. The IMF is drafting new digital frameworks. CBDCs, central bank digital currencies, are being tested as a form of control, masquerading as convenience. Why? Because those who manage the system know what's coming. They don't trust the current structure either. They're building lifeboats while telling the passengers to relax. Meanwhile, the public is being pacified with new distractions: artificial intelligence, climate panic, digital ID rollouts. All real in some sense, but all conveniently timed to distract from the one thing no one wants to admit. The system of money is dying in plain sight. And it's not a conspiracy. It's a formula. Debts that grow faster than incomes, assets that grow faster than productivity, interest that grows faster than trust. That's not ideology. That's arithmetic. And arithmetic, unlike politics, cannot be debated. It doesn't care about speeches or media narratives. It just adds until the sum is too large to carry. 2026 is the year many of those numbers come due. Not metaphorically, literally. They'll say it was a surprise. They always do. They'll blame a shock, a war, a virus, a vote, something unpredictable, something outside the system. But the truth is simpler, colder, sharper. It was the numbers. The collapse doesn't begin when the headlines say it does. It begins quietly, when debt grows faster than growth, when governments stop investing and start borrowing just to survive, when interest payments crowd out education, health, infrastructure, when central banks become addicted to saving everything except discipline. We don't notice it at first because we don't feel numbers. We feel narratives, and the narrative told us it's under control. Inflation is temporary. Debt is sustainable. Growth is coming. We believed it because we wanted to, because admitting otherwise would mean facing the truth. The system stopped being real a long time ago. Money stopped being a store of value and became a store of politics. Markets stopped reflecting the economy and became escape rooms from reality. But the clock is ticking. Every dollar borrowed today demands $1 and change tomorrow. Every suppressed interest rate pushes the future cost higher. Every illusion borrowed against time eventually runs out of it. 2026 isn't a prophecy. It's just a point where all the math lines intersect. A December when liquidity thins, debts mature, trust shakes, and someone, somewhere, realizes the emperor's not just naked, he's broke. What happens next won't be fair. It won't be smooth. But it will be natural. Because systems don't collapse because of villains. They collapse when people stop believing. And belief, once broken, can't be printed back into existence. So now you know. You've seen the pattern. You've watched the illusion flicker. And you've heard the clock. If you're hearing this in 2025, remember, this isn't just about money. It's about trust, time, and truth. And in the end, those are the only currencies that matter.